Hey, what's up, everybody? Tuesday, February 8th. Market bouncing. Like I said yesterday, market bouncing. Fiscal flows for for February, looking good right now. We're running at about a 29 billion, 28.7, something like that, 28.7 billion per day. That's the 10-day average of the fiscal flows. That's about 580 billion monthly. That's strong. That is strong. And we have an 82 billion deficit for the month so far. That's good. Remember, a deficit equates to a net transfer of financial assets to the non-government, to the economy, income, savings. So that's good. 82 billion. We are in a deficit month, and I said February, that historically, seasonally, that's a big spending month because you have IRS tax refunds. Okay, February is usually the biggest month for IRS tax refunds. And you have a quarterly interest payment, which will be hitting up on around February 15th. That's going to be like 42, 44 billion. So February should be a good month, and it should power the market higher. Today we saw a very good 3-year treasury auction with very strong foreign demand, and no surprise, we see a record trade deficit. So foreigners sell us stuff, they get dollars, and they hold their dollars in the form of treasuries, which is like a savings account of the US government. They get some interest on it. They're not lending us dollars, okay? They sell us some stuff, whatever. Cars, clothing, toys, electronics, you name it. They sell us stuff. They get dollars, and they park those dollars in treasuries, which are basically dollar equivalents. The only difference in a treasury is that it has a term, like 2 years, 3 years, 5 years, 10 years, and a coupon, which means it has an interest rate payment attached to it. And they're easily convertible back into cash, and those are dollar equivalents. There is no lending going on by foreigners. Once again, they sell us stuff, cars, toys, textiles, whatever else, and electronics. They get the dollars, and they hold the dollars in the form of treasuries. That's all that's going on. Now, if you have a record trade deficit, which means demand here in the United States is very strong, and that also comes from, fiscal support, fiscal stimulus. Demand is very strong, and so we buy foreign goods. They tend to be cheaper, although Trump, when he put those tariffs on, remember that? Back in, 2018, 2019, when he put all those tariffs on, that raised prices, okay? And it did not help in narrowing the trade deficit. That raised prices, so it's inflationary. And he talked a lot about that, how he was going to bring manufacturing back and how he was going to, I'm really going to teach those Chinese a lesson. It's costing us Americans money, those tariffs are. It just raised prices for consumers, and that's adding to the inflationary pressures because those tariff costs are passed along to us, the consumers. So it didn't do anything to help. And imports are a benefit, and exports are a cost. And I know a lot of people are going to take issue with that, but I've explained it many, many times. It's much better for foreigners to labor for hours and hours and hours, like the Chinese labor, under sometimes slave type conditions, very hard conditions, and they earn, fractional amounts of pay compared to U.S. workers, and they use their resources, and they despoil their environment, and we get the benefit of the real goods, the real assets, which are the goods, in exchange for dollars, which are basically electrons. They're electronic credits in some bank account. And, our standard of living is defined by our real assets. I mean, go to any poor country. I wouldn't have to tell you that the country is poor. You would see they have very little real assets. They would probably have dirt roads, no hospitals, very little food, maybe people walking around in tattered clothing, if that, no modern appliances. I mean, you would know it. Nobody would have to say to you, hey, that's a poor country. Your eyes would not lie to you. And it's about the real assets. And vice versa. If you go to a rich country, like the United States, or some places in Western Europe, or even, in parts of China now, if you go to these countries and you see like modern skyscrapers and beautiful airports and abundance of food and consumer goods and, fantastic healthcare and medical facilities and hospitals, you would say that's a rich country. You wouldn't have to have somebody tell you. So what defines it? It's the real assets. Anyway, I went off on a tangent there. February is a big fiscal month. All right, we flipped back into deficit. By the way, if you want to calculate these deficits and surpluses on a day-to-day basis, once again, I tell you, go to my website, pitbulleconomics.com, and get my course. It's a video course called Understanding the Daily Treasury Statement. It shows you, or I show you in that course, how to get the data off of the daily Treasury Statement, which is free. The Treasury puts it out every day at 4 o'clock Eastern Time. And you could have fun calculating to your heart's content, not just the deficits and the surpluses, but the daily flows and all that other stuff, plus a lot of other cool stuff that you could talk to your family and your friends and your colleagues at work and show them how they don't know what they're talking about, or they have very little understanding about our monetary system. Like if they're afraid, Social Security is going to run out of money. I mean, there's a lot of cool things in there once you understand it. And maybe it's going to make you a little bit frustrated and a little bit mad, because once you understand it, you say man, why are we hearing all this misinformation and these lies about, what we may be facing in the future, or how, you don't have money to pay for this, or you don't have money to pay for that. I mean, once you understand it, it's kind of a thing that's going to make you a little bit frustrated, or a lot frustrated. I know it did that to me. It made me mad. It made me freaking mad, I'll tell you, and it still does. Hey, there was a great article in the New York Times. I don't know if you saw it, on Stephanie Kelton and MMT over the weekend, and it got Larry Summers. Oh man, he just lost his shit completely over this, and he went on the attack. Now, Larry Summers is known as a guy who basically all of his predictions have been wrong. And he was the guy who presided over a policy change back in the 90s, him and Robert Rubin, who was Clinton's Treasury Secretary, and they were behind this push to, end Glass-Steagall. Glass-Steagall was a long-time regulation which separated banks from investment banks. They said, get rid of that. Let the banks play and speculate. That's going to be good. It's competition. It's going to be great for the financial industry. It eventually led us into a situation where, we had to bail out the banks because of all their failed investments, etc. But Larry Summers, boy, he went on a rampage against Stephanie Kelton. Kind of almost sexist, I think, in his attack, although I'm sure he would deny it. But, I don't know. I mean, the guy, he's one of these zombies, policy zombies who are still around. They're failed in every regard. He was kicked out of Harvard. He was the president of Harvard. He made, again, sexist remarks about women, about how basically they're not as smart as men in science and math and that sort of stuff. They kicked him out as president of Harvard. I mean, but he's one of these zombies that you can't kill. Still around, still pushing this neoclassical economic garbage, which just completely wrong and inapplicable. It's another one of those situations where all their predictions and all their forecasts turn out exactly opposite of what they intended would happen. And never do they go back to the drawing board and say, our theories were wrong. We got to reassess what went into this line of thinking and why it is not playing out in the empirical evidence like we think it should. No, they never do that. They never do that. They just double down on the same thing. Anyway, I don't know if you saw the article, but it's out there. I think it's called, the title of the New York Times article was, should MMT, it's time for a victory lap. And there's a big picture of Stephanie Kelton there. Just for FYI, for your information. So, February is going to be good for stocks. We have still high levels of bearish sentiment. That's going to start to come down as the market rallies now. And we'll see what happens. I said yesterday in the video that we are back in a kind of a normal environment, which was a pre-pandemic stock market environment where you had normal ups and downs in the market. Over time it was trending higher, but it was tradable. You had ups and downs. It wasn't like the last 2 years when we've had unprecedented amounts of fiscal stimulus, so the averages were just going straight up every single day. That's over right now, and we've settled back into what I would say is a normal market pattern, a normal economy, which that's we're talking about sub 3% GDP growth, hopefully positive as long as they don't run surpluses. We're going to have market swings in both ways, up and down. I think sentiment right now probably becomes a much better indicator. But somebody said on here in a comment, "Oh, Mike, you said yesterday the market's gonna bounce." You didn't give us a chance to buy in a correction. If the market is going up, look, today at one point the market lost its gains. It opened up strong, then it went down. You buy those dips. You have dips every single day, intraday. Don't think you're going to get 10% down or 20% down every week for your, and by the way, a lot of you, when it does go 10% or 20% down, you're crying. You're afraid to go in. You don't go in. We just had that. So yeah, if it's going up, you get intraday pullbacks. You get certain stocks, maybe stocks that you follow or you own, where they're down on the day. You buy them when they're down on the day because they'll pop back up. The broader trend will lift it up. All right, that's all I got to say for today. If you want to get my course, Understanding the Daily Treasury Statement, it's $99. Go to my website, pitbulleconomics.com, and check it out. It's under courses, or just send me an email at mnorman@pitbulleconomics.com, and I'll hook you up. Bye.